Canada has spent years worrying that housing would be the thing that finally breaks the country. But one of the strangest warning signs in the Canadian economy may not be sitting inside a Toronto condo. It may be sitting in the driveway. A 2026 Ford F-150 Platinum starts at about $93,000 in Canada. A GMC Sierra Denali starts around $94,500. And a Denali Ultimate, more than $116,000. These aren't exotic supercars, they're pickup trucks. And Canadians have found a remarkable way to make vehicles this expensive feel affordable. Stretch the loan until you stop thinking about the price. 72 months, 84 months, even 96 months. The federal government has been warning Canadians about exactly this kind of financing for years because it can leave borrowers owing more than their vehicle is worth. Meanwhile, Canadian households now carry more than $3.25 trillion in credit market debt, roughly $1.80 of debt for every dollar of disposable income. And here's the part most truck buyers don't think about. Your car payment doesn't just determine what you can afford to drive. It can determine what house you can afford to buy, because Canadian mortgage lenders count car payments when calculating your total debt load. The truck isn't going to cause a recession by itself, but it may be showing us something much more important: how far Canadians are willing to stretch debt just to look like they're doing fine. And that's where this gets dangerous. There was a time when a pickup truck was pretty easy to understand. You bought one because you hauled equipment, worked construction, towed trailers, ran a farm, or actually needed a truck. That version still exists. But walk through the upper end of today's Canadian pickup market and you find something very different. Ford's 2026 F-150 Lariat starts at about $72,800. The Platinum starts around $93,000. GMC's Sierra Denali starts around $94,500. And the Denali Ultimate begins above $116,000. For context, Statistics Canada reported median after-tax income for Canadian families and unattached individuals of about $75,500 in 2024. So we're now talking about mainstream pickups whose sticker prices can exceed an entire year's median after-tax income. And manufacturers aren't pretending these are only work tools anymore. Ford literally markets the Platinum with the phrase, "the truck to be seen in." That's an incredibly revealing sentence, because somewhere along the way, the pickup stopped being just transportation. It became an identity, a reward, a signal that you're doing well. And that matters because people behave very differently when they're buying status instead of utility. A $90,000 truck sounds insane, but $1,200 a month? Now your brain starts negotiating. Maybe you can cut somewhere else. Maybe the bonus will be good this year. Maybe you deserve it. Maybe it'll hold its value. Maybe you'll make more money later. And suddenly the question isn't, should I spend $90,000 on a vehicle? It's, can I survive the payment? That change in thinking is the entire business model, and you can see it in the advertising. Ram is currently advertising a 2026 Black Express at $179 per week with $2,395 down, financed at 4.99% for 84 months. The offer price is $57,319. The total obligation? More than $65,000. Notice which number feels smaller. $57,319 or $179 a week. That's the magic trick. And it works because Canadians weren't always this sensitive to the cost of borrowing. For years, borrowing money was unusually cheap. The Bank of Canada's policy rate sat at just 0.25% from March 2020 until the tightening cycle began in 2022. Then everything changed. Between March 2022 and July 2023, the bank took that rate from 0.25% to 5%. Cheap debt had trained consumers to think differently. Instead of asking, how much does this thing cost? More purchases became, what's the payment? And once customers start shopping by payment, almost any price can be made to look reasonable. You just need more time. The Financial Consumer Agency of Canada has specifically warned consumers to look at the total cost, not just the payment or the advertised interest rate. Here's their own example. Take a $25,000 vehicle financed at 5%. Over 3 years, total interest is about $1,974. Stretch the same purchase over 7 years. Interest rises to about $4,681, more than twice as much interest for the exact same car, but your monthly payment looks nicer. That's the trade. And Canada has been warning about 72, 84, and even 96-month loans since at least 2016. 8 years. Think about that. A kid could enter grade 5 when you buy the truck and be preparing for university before you make the final payment. And during those 8 years, something very inconvenient is happening. The loan is slowly going down, but the truck's value, that's moving much faster. And that's when a normal car loan turns into a trap. Financing didn't just change how Canadians bought vehicles, it also changed what automakers could sell them. Take the F-150. There is still an XL work-oriented model, but climb through the lineup and the truck slowly transforms. Leather, massive screens, premium audio, hands-free driving technology, power running boards, heated rear seats, luxury trim. Ford even describes some of these models in language that sounds more like a luxury sedan than a construction vehicle. And financially, that transformation makes perfect sense. If a customer only looks at sticker price, jumping from a $50,000 truck to a $90,000 truck is horrifying. But if you stretch financing long enough, that enormous difference becomes a few $100s more every month. And suddenly, the expensive trim becomes psychologically reachable. That's why the most interesting question isn't, why did trucks become so expensive? It's, how did consumers become capable of absorbing prices this high? The answer is debt duration. Canada's auto financing system increasingly allows the cost of today's vehicle to be pushed far into tomorrow's income. And manufacturers don't even have to hide it. Current Canadian Ram offers openly include financing over 84 months, 7 years. And federal consumer protection material explicitly discusses 8-year auto loans. The price didn't disappear. It was stretched. And there's one massive problem with stretching the financing of something that loses value. Time is working for the lender, but against the asset. This is where the math gets ugly. The government of Canada gives a remarkably clear example. Imagine buying a new vehicle worth $31,300. Taxes and fees push the loan to $35,000. You finance it at 4% over 8 years. Your payment is only about $425 a month. Sounds manageable. But after 1 year, the government estimates the car could be worth about 25% less. Vehicle value, $23,475. Remaining loan, about $31,200. You are already roughly $7,725 underwater. After 2 years, the example shows negative equity growing to about $8,520, and that's on a $31,000 vehicle. Now imagine the psychology on a $90,000 truck. You make every payment. You're doing exactly what you're supposed to do. Yet for years, selling the truck may require you to bring money to the table. That's negative equity. You don't just own a depreciating vehicle. You own a debt balance attached to it. And this becomes especially dangerous when people trade vehicles before finishing the previous loan. The Financial Consumer Agency of Canada warns that if you trade in a vehicle with negative equity, the unpaid amount can effectively follow you into the next financing arrangement, creating a larger loan and more interest to pay. So imagine this cycle. You buy a $70,000 truck. 3 years later, you want something newer, but you still owe more than the truck is worth. The dealer can take the trade. Great. Except the debt didn't vanish. Part of yesterday's truck can now be sitting inside tomorrow's loan. You are financing the new vehicle, plus the financial mistake from the old one. And that's how a person with a nice truck, a good job, and perfect monthly payments can quietly become poorer every year. Not because they missed payments, because they never escape them. But eventually some people do start missing them, and Canada is already seeing where the stress concentrates. This part matters. Because if expensive vehicle debt were only a problem for rich homeowners with plenty of savings, it wouldn't be particularly interesting. But that's not what the data shows. In 2025, the Bank of Canada reported that credit card and auto loan arrears among households without mortgages had climbed back above historical levels. Equifax also reported that among younger consumers, auto loan delinquency had risen 30% year over year to 1.95%. Now here's where we need to be precise. Canada is not currently experiencing some giant auto loan collapse. The Bank of Canada's 2026 Financial Stability Report says household stress broadly stabilized over the previous year. Canada's financial system remains resilient. But look beneath the average. Around 2.5% of borrowers without a mortgage were more than 60 days late on at least one account. For mortgage holders, around 1.3%. That's the fascinating part. The people showing more stress are disproportionately the people without the mortgage, the renters, the younger borrowers, the people who haven't accumulated the giant housing asset everyone assumes is Canada's biggest financial problem. And that's why comparing this directly to 2008 misses the most interesting Canadian angle. Canada doesn't need an American-style auto loan collapse for expensive vehicle debt to matter. The financial system can survive. Banks can survive. Automakers can survive. The person trying to buy their first house? That's a different story. Because in Canada, your truck payment follows you straight into the mortgage application. And this is where a $90,000 truck becomes a housing story. When Canadians apply for a mortgage, lenders look at something called the Total Debt Service Ratio, or TDS. For standard insured mortgage qualification, CMHC generally caps that ratio at 44% of gross income. And that includes mortgage costs, property taxes, heating, credit cards, personal loans, and yes, car payments. Let's make that real. Imagine a hypothetical Canadian named Alex. Alex earns $80,000 a year before tax. That's about $6,667 a month gross. At a 44% TDS ceiling, the rough maximum available for all qualifying monthly debt obligations combined is around $2,933. Now give Alex a $1,300 truck payment. Before we've even discussed a house, that truck has consumed roughly 44% of Alex's total debt service room. He's left with around $1,633 for housing-related debt service and any remaining obligations. The truck didn't literally cost Alex a house, but it absolutely competes with the house. That's not an opinion. That's how mortgage qualification works. And there's another cost you don't see. Cash flow. A $1,000 monthly vehicle payment is $12,000 a year, $60,000 over 5 years, before fuel, before insurance, before maintenance, before parking, before the next vehicle. Not every dollar is lost. You still own an asset, but that asset is depreciating while the down payment you didn't save never had a chance to exist. That's the real trade. And it's why one of the most expensive vehicles in your life can quietly reduce your ability to buy one of the most valuable assets in your life. The truck payment doesn't replace the mortgage. It competes with it. Now combine that with Canada's broader debt picture. Household credit market debt reached about $3.25 trillion in early 2026. That's roughly 179.6% of disposable income. Statistics Canada also tracks roughly $110 billion in household auto loan liabilities. So this is not really a story about people liking trucks. It's a story about balance sheets, housing debt, auto debt, credit cards, lines of credit, food, insurance, utilities, all stacked against the same paycheck. And that's where the recession part of this story finally makes sense. Here's the mistake people make when they hear auto debt crisis. They imagine trucks somehow collapsing Canada's banking system. That's probably not the right fear. Auto loans can be securitized in Canada just like other forms of consumer credit, and regulators have rules governing securitization exposures. But current Bank of Canada assessments do not describe Canadian auto loans as a 2008-style systemic bomb. The Canadian banking system is currently described as resilient. Households on average are still servicing their obligations. That's important, because the truck isn't the bomb, it's the warning light. In the first quarter of 2026, Equifax reported that new captive auto loans fell nearly 5% year over year, while bank installment loan volumes dropped about 9.5%. People are becoming more cautious. Credit is becoming more selective, and the Bank of Canada says the biggest danger to household finances isn't some mysterious financial product. It's much simpler. A downturn that causes job losses. Because debt feels manageable when your paycheck arrives every 2 weeks. A $1,200 truck payment is annoying. Then hours get cut. Someone gets laid off. A contract disappears. A household drops from two incomes to one. Suddenly, the same payment isn't annoying. It's lethal to the budget. And unlike a house, the vehicle you've been paying for may be worth dramatically less than the amount of money you've already poured into it. That's why expensive trucks matter. Not because every Canadian driving one is broke, not because buying a truck is automatically stupid, and not because F-150s are secretly going to destroy Bay Street. They matter because they reveal the mentality that cheap and extended financing created. If I can make the payment, I can afford the thing. Those are not the same sentence. And when millions of households are carrying large fixed payments at the same time, a recession becomes more painful because people have less room to absorb the shock. The Bank of Canada's 2026 report says Canadian households remain highly indebted and vulnerable to job loss or large unexpected expenses, even though overall financial conditions remain stable. That's the distinction. The crisis doesn't have to begin with the truck. The truck simply tells you how much fuel is already sitting on the household budget before the match gets lit. For years, Canada's economic anxiety has revolved around housing, and for good reason. Homes are expensive, mortgages are enormous, and household debt is high. But maybe the more revealing question isn't, what asset will cause the next recession? Maybe it's, how financially exposed are Canadians when the next recession arrives? And that's why the $90,000 pickup matters. It's a depreciating asset, financed over 7 or 8 years, sitting beside a house its owner may still be trying to qualify for. It represents something bigger than transportation, the ability to purchase the appearance of prosperity long before you've built the financial security behind it. And maybe that's the strangest part of this entire story. The truck didn't suddenly become affordable. We just became better at hiding the price inside the payment. So Canada's next downturn may still involve housing. It may involve trade, unemployment, consumer spending, or something nobody sees coming. But if you want to know which households are most vulnerable when it arrives, don't just look at the mortgage. Look in the driveway.